Okay, we'll give it some time to see all the participants coming in. Also, it's not 12 yet. Okay, we'll give it like 45 more seconds so people can come in. Okay, I think we're just ready to dive in. Okay, so hi everyone. Thank you so much for joining us today. I'm your host, Rebecca Stevens. I'm a research analyst on the data team at The Block, and I'm really excited to moderate today's webinar. Today, we're going to be talking about how we move forward as an industry after the collapse of FTX and just more broadly, the crazy past year we've had, specifically looking at the evolution of exchange, trading, and custody. I'm thrilled to be joined today by our amazing group of panelists who I'll let introduce themselves. We can just go around and you can say your name, title, and where you work, and we can just go in alphabetical order.
Okay, I guess I start first. My name is Eugene Cheung. So I'm the head of institutions for Bybit. So I'm running the Bybit institutions business, working with the different clients, also including our institution partners. Before Bybit, I was with CME for almost 9 years, and before joining Bybit, actually with another platform called TradeWeb.
Hey everyone, my name is Junde, or you can also call me JD. So I head up the global sales team at Cobo. So Cobo is a licensed provider of custody solutions for digital assets, and we're headquartered in Singapore.
My name is Luuk Strijers. I'm Dutch. I'm Chief Commercial Officer at Deribit. Deribit is the world's biggest crypto options platform. We are based in Panama, so am I. And before my role, I started in 2019, and before that, I was with SGX in Singapore.
Okay, so as you can tell, we've got an excellent group of speakers today. Also, as we begin, feel free to type any questions you have into the chat because we'll save the last 15 minutes to be a Q&A session from attendees of the panel. So naturally, the collapse of FTX shook the crypto industry. It created a movement for more transparency and highlighted the importance of custody. So now we're here to talk about how we move forward and how exchanges and custodians are working to evolve in this new landscape. We're going to start off by talking about how centralized entities are currently building trust with consumers. So proof of reserves was the hot topic coming out of November as many exchanges move to prove that they do have the money that clients are depositing on the exchanges. But there's been some pushback between providing liabilities information, and now there's even few firms willing to do those reserves. So what else is there to do or share about your current operations to further transparency and build trust? And additionally, are you making any changes to how you operate due to recent events?
Who do you want to start?
Oh, anyone can start if you have strong opinions.
I'll share mine. So we started like many others after FTX in sharing our wallets as well as liabilities. We do this for every coin, so we are fully transparent on the asset side as well as on the liability side. We do this on a daily basis. So per exchange, it differs a bit how frequently they share these numbers and whether it's like a Merkle tree or full transparency. We've chosen for the latter. So in order to protect privacy, we've cut balances in pieces. So let's say if you have 100 BTC, you would be included in the liability side in 10 different random chunks of assets. So it's impossible to to link a certain entry in the liability file to a certain client. But clients can see for themselves which liabilities are there, and in the system they see the total overview. The system shows a coverage ratio, so for every asset you have a verified way of making sure that the assets are actually available on chain. So we've been rewarded like top-notch recognition by Nick Carter the other week, by Hop Trail. So I think that's like a nice step forward. We've been, like any exchange, a bit hesitant because there's also like security stuff involved. It's easier to protect the assets and wallets that are yours instead of being fully transparent. But I think the need for full transparency has changed, and every client wants to see this kind of stuff. So we've done that. But separately, you asked, what else can you do? We just finished penetration testing, so we are about to share the report there, which is like a publicly available report showcasing the tech setup. So how safe and secure is it? We want to be fully transparent on that level as well. We are about to have 3 custody solutions implemented. So if you don't trust us and our custodies, our proof of reserves, we can offer 3 alternatives. So we will talk about that in a second. We are getting regulated in Dubai, which again is a verification of all your policies and procedures. So it's not only about how you run the market itself, but it's about like 30 different policies and procedures are required as part of that, which includes like office entry security and ISO certification, SOC 2, all that stuff. So in the end, we and as well as many others try to be as transparent as we can be in order to safeguard trust. I think we have a very good reputation, but of course, over time, and especially after events like FTX, the standards are the standards people require are getting higher and higher. Which in the end, it might be a little bit annoying building all of it, and it's a distraction. But in the end, a few years from now, we will hopefully FTX is a blip on the radar, and it's not more than that, and we've all elevated ourselves to higher standards.
Yeah. I met client every day. Before the FTX, I've been, when we sit down, and the most client, especially institutional client, the focus points about I want to have a better fees, I want to have a better API, latency, those kind of questions. But these days, after the whole FTX episode, and the first question is definitely is about the POR, about the risk, about the counterparty risk, those kind of questions. So we do something very similar as just Luuk mentioned about, right? We also released the POR. We are integrating with the third-party custodians provider, getting a license in Dubai. So it's something very similar. I guess the thing I want to add is like we also have a client, especially like a lot of like big institutional client, they try to reduce their exposure to one exchanges, right? It's kind of spreading out their capital among few couple big exchanges. So in the way how we can support our clients, we actually try our best to increase their capital efficiency. So we have been building this UTA account, unified trading account, which means that you can cost margin between the spot, between the futures. You can do the portfolio margins between the options and then the perpetual, right? So that the client can put less of capital, but basically still can utilize their the same strategies. Yeah, we also come up with this OTC loan program. It's the same things that try to increase clients' capital efficiency, so that they don't have to put they can reduce the amount they put with us, but they still can do a lot of trading on us.
So for us, Cobo, FTX was a huge incident for our industry, but we are on good foundation because we've been securing billions worth of customer assets with 0 security incidents over the past 5 years. We're also licensed, we're also SOC 2 certified, so we are well positioned to react positively to this. So from what we gather from our clients, the funds, what they seek the asset managers, they seek a few things from custodians and exchanges. And 2 of the more important things would be efficiency, the capital deployment, and also minimal counterparty risk. Actually, back in 2019, we launched Luuk, which is an instant settlement network to enable instant and free transactions from within custody to exchanges in our network. So funds can enjoy very efficient capital deployment to exchanges. But in terms of risk management, especially with this episode, we could do more. So since the FTX incident, we've upgraded Luuk to Super Luuk. So with Luuk, transfers were instant and free, but you still had to transfer tokens to pre-fund the exchange before a trade. But with Super Luuk, you do not need to pre-fund the exchange. So let me describe simply how this works. So the asset manager would lock some funds, say 100 BTC from within their Cobo MPC multi-party computation wallet. And then we would communicate by API to the partner exchanges, and the exchanges would then provide a 100 BTC mirror or credit line in the asset manager's exchange account. And from then on, the trading experience will be exactly the same as if they had deposited tokens on the exchange to trade. Only upon settlement would we send tokens to the exchange. So how would this reduce the impact of extreme scenarios? So if the exchange goes completely down like FTX, we as the custodian, we would not send the locked collateral over. And secondly, as part of the MPC construct, if the custodian goes down or goes offline, the wallet owner can still recover keys and funds together with our backup third-party key holders like CoinCover, Newman, and Nimin. So one important thing to note is that in our implementation of the off-exchange settlement network, throughout the entire process, before the point of settlement, funds always remain in custody of the asset manager, even when they are locked. So no single party can misuse the funds. So by reducing counterparty risk with innovative technology, we hope to bring back the trust in the trading volumes. But to be honest, I think this is an industry movement which requires the cooperation of all custodians, funds, regulators, and most importantly, the exchanges to work together. So at Cobo, we are very excited to be also working with Luuk and his forward-looking team at Deribit. And we're also in conversations with the team at Bybit to realize this, what we think it's a paradigm shift in the crypto trading industry.
Okay, all great ways to build trust and transparency. So with all of that you guys are doing, what do you view as the biggest challenge to rebuilding the trust? Like, you can do all of these things, but have you run into any challenges with rebuilding trust with the clients?
Yeah, let me answer this one. I think in the end, it's not what concerns you most. It's essentially what you do. So we've always been transparent, and as long as you remain transparent and share with clients what is happening, what are you aiming to build, what went wrong in certain occasions or whatever, we are far from perfect. But as long as you don't try to hide, but always remain transparent about the state of the platform and the growth path, I think that's the most important. So I don't really see hurdles at the moment. We've stepped up like 10 times in terms of transparency versus a few years ago. So solutions like Cobo, like the custodial solutions in place, the proof reserves, that kind of stuff. No one did that in the early days, and all of us are stepping up now. So it's a path and not really a hurdle that we need to cross. It's in a few years' time, I think we've come up with more and more items. I think what is still missing is financial transparency, which is a difficult thing to achieve because you need auditors, and you need a solution which is like public and fully transparent without 6-month delays, which is tricky to overcome. But in a few years' time, perhaps balance sheets and P&Ls are available on some chain as well, and publicly shareable without delays of audits. I think in the end, instead of 100 exchanges, there will be 10 exchanges, perhaps 20, and instead of 50 custody solutions, there will also be 5 or 10. And with that group, we will elevate the standards to higher levels, and it's I'm fully committed that that's going to happen, and Deribit will be a key part in that. We've always been transparent, and we aim to remain that way. So we are a big supporter in this kind of stuff. That's why we also had Cobo, I think in 2019 or 2020. We've already had that a few years. We are also upgrading to Super Luuk. We have Copper in place. We're integrated with Fireblocks. So we're always interested in that kind of stuff that achieves trust and better or higher standards for the infrastructure.
Yeah, I mean, from our side, we also don't see there's a like big challenge to building the trust, right? So as one of the, I mean, the Bybit itself is almost I mean, it's already like more than 4 years old exchanges, right? So it's quite established exchanges. We achieved the very top volumes. So even after the FTX collapse, there's no much impact in terms of our business, right? The brand's there. It's kind of benefit us, to be honest with you. So you can see that the volumes kind of consolidate to those top exchanges, right? I'm pretty sure it's also benefit Deribit, right? You definitely see a big rally in terms of volume for in the January, right? I mean, December is a little bit depressing, but the January actually we all see very good surge in terms of volume. So yeah, I guess it's like because your brand there, you have your reputation there. It's quite easy that it's not easy to lose your trust from the clients. Yeah. I mean the one thing is that is the auditing, right? Because a lot of people asking for the auditing, but I mean it's kind of in terms of regulation as well. It's like it's not like we as exchange we don't want to comply fully comply the regulate and we definitely want to embrace all the regulations, but sometimes the regulation frameworks are not very clear, especially to the product you try to offer, right? The business you try to offer, right? So same with the auditing is that we want to have fully audit, but the problem right now is like the auditing, the current practice it doesn't really 100% fit for the you know crypto exchanges, right? So but we definitely see that we always believe that you know that the day will come, right? Like there's going to be very clear regulations, there's clear like audit practicing, and then we will fully embrace that. And then we think that's very important because it's essential. Like the mainstream institution will come, right? And then you will increase the business and also help the industry to grow for long term.
Does anyone want to add anything or all good? Okay, then we can move on to talking more about custody now. So both Trezor and Ledger reported huge increases in sales after 2022 as people started seeing the need to self-custody their crypto assets. But obviously using a custodial solution is often easier than needing to like self-custody your assets. So there's still a need for custodial solutions and people are now looking for the best way to hold their assets. How have you seen demands for customers change since the end of last year in terms of custody?
So for us, Luuk, please go ahead. Yeah.
Oh yeah, you are the specialist.
Okay, cool. So firstly, Ledger and Trezor, they're huge brands in the retail crypto user space. So we specialize more on the enterprise institutional side. So I know Ledger and Trezor had huge sales since the FTX event. We've also definitely had an increase of inbound of global inquiries, you know, but I think the requirements will be quite different because institutional clients, they have different requirements around workflow efficiency, recovery options, off-exchange settlements, and so on. I mean, some workflow efficiency examples, meaning like, okay, let's say if you have millions of dollars or tens of millions, hundreds of millions of dollars, you have different teams, staking teams, trading teams, payroll team, vendor team, and so on. You can't give your ledger to everyone or private key to everyone to operate. So with custody solutions, you can set specific workflows where specific teams can only do withdraw specific thresholds, specific tokens, and so you're able to operate quite efficiently. Yeah. So that's the difference between I guess the retail facing brands as well as us. Yeah.
I think we've seen comparable developments. So the number of people choosing Copper or Cobo or soon Fireblocks has increased. So the level of interest in institutional solutions linked to platforms has grown. So I think those companies are doing well. For us, we're just merely there to facilitate. So our belief is always, if the large clients want a certain solution, who are we to object as long as we trust the solution? So as long as its security is top notch, etc. So that's why we have 3 custodians, and who knows, we might add a few more in due course. For us, the way it works is we lock assets within those custodians. So the first version of custody solutions was, as Daisy mentioned, clients deposit from the custody solution to the platform in a let's say, off-chain world. The next version would be these assets stay in this off-chain world or on-chain world, and we technically or cryptographically lock assets in those accounts without those assets leaving the account. So in the future, in Copper, in Cobo, in Fireblocks, you can keep your assets without trusting the exchange, and we would only settle the P&L on a daily basis, which of course elevates the level of trust in the overall solution offered, because if you doubt the exchange or the overall solution, it doesn't even have to be exchanges, it can be miners, it can be anything. You can keep the assets with the preferred solution of choice, and still have access to the platform, still be able to trade, and only have the P&L being settled on a daily basis, which, yeah, I think is the perfect solution. That's why we're quite committed in building and marketing this, because we see a lot of demand and a lot of people recognize the potential there.
Yeah, so we basically getting the similar feedback or requests from the clients. We definitely see that it's going to be a requirement, especially for institutions. So especially and also for like people, you know, basically manage a hedge fund or CTA or asset management firms. It's quite clear that they probably cannot onboard exchanges in the future if you know you're not able to offer a third-party custodian as a service. So we are also proactively working with several major vendors try to integrate with their third-party custodian service. And I mentioned before, it's like we also have in mind that we want to make sure try to make sure there's enough capital efficiency, and also make sure that at the same time have everything's under the best risk management standard. Yeah, I think it could be interesting too in the future development. What I see, especially you come from a traditional financial world, right? Because in the traditional financial world, actually the exchange and the custodians are already separate, right? And then actually, I mean, the good thing right now in the exchange, like OCC or those kind of provider in the traditional financial world, eventually you even can offer some kind of a cost margin between the exchanges, right? You kind of you have your separate custodians, basically link up with the different exchanges, right? That can another development in the future. Definitely not right now, I can see, but I can see there's a direction, right? Once we have this, and some people come out with solutions, basically say, okay, if you're connecting with two exchanges, and then you're holding the all asset in one place, I can offer you, further kind of like a capital credit, right? So I also see that that's going to go for the business in long term.
Okay. So also on the topic of custody, last week we saw a crazy scenario play out in the US banks, which is kind of like a way that people custody their fiat. So how do you think the banking crisis that we saw last week will impact crypto custody going forward? And has it impacted your businesses at all since it happened?
So we help customers be in control of the assets by enforcing a couple of important principles. So one, the customer is at any time the only party that can unilaterally move the token. And two, in every extreme scenario that we can think of, the customer loses the key, exchange goes down, custodian goes down, there are recovery mechanisms. Okay, so that's how we help customers be in control. And with the banking crisis, the one key theme that's emerged, at least for us, I think would be diversification. Okay, because over the past year, we've seen banks, custodians, exchanges, stablecoins all run into all sorts of issues. And many of these companies are actually regulated, and everyone claims they are very secure. But what we've seen is that no company is too big or in some ways too regulated to fail. So I think diversification as a risk management strategy, diversifying across bank accounts, across stablecoins, custodians, jurisdictions, this could be a much bigger risk management strategy moving forward. And as Luuk mentioned, they're working with multiple custodians. this is I think that's a very good risk management strategy.
Yeah, so how has it impacted us? So we offer USDC trading, so it impacts us slightly, as in once the DPEG occurred, you saw prices at some point 88 cents, somewhere like that. So you see the contracts trading at a 12% premium versus the regular USD ones. So that's one thing you notice. Of course, market makers back out, and everyone is concerned if a stablecoin loses its peg, it's tricky, of course. How can you quote? So it impacts liquidity. In the end, I think I agree that it's a diversification issue. 3.5 billion at a single bank, which is 1/3 of their cash reserves. The weird thing is so if we have a bank run, so we have proof reserves, as you know, so we have 100% of the assets. So if we have a bank run, it's of course, if we have 0 assets left, we are out of business, but we can give all the assets to the clients. So in the end, besides our future, there's 0 problems. But in the US, it's different, or in any banks, it's different because of fractional reserves. Not all the cash is there. They don't have a proof of reserve ratio of 100%. It's invested, it's borrowed, it's whatever. There's a bunch of stuff being done with it outside of the bank, and therefore outside of their control. If we have 100,000 BTC, we can showcase that we actually have it. So those are not borrowed out in exchange for real estate or other investments. They're actually simply within our control. So the weird thing that happened is that this system started shaking a bit, which caused a lot of concerns, which made made USDC lose their peg, which is a strange thing in the end, because the only thing that is meant to do is secure stability, and the only thing that it didn't for a brief period of time was doing that. So how to solve that is not easy. Because you need banks, but perhaps there will be more banks, I assume, going forward, perhaps in different countries. The diversification across a few banks will most likely be changed into many banks going forward, which will again increase the cost, and yeah.
Yeah, I mean, from our side, the thing I want to add is more about, yeah, this is more like a banking crisis, right? So the issues with the bank, but it just so happened like all these bank that has issue like Signature, Silvergate, they are more crypto friendly, right? But eventually it's like because of research, they still make it at whole, and so we don't have a like much impact just based on the last weekend's the banking issues, right? But at the same time, we do thinking about what we do allow like more flexibility to the clients, so that we've been it's not only for the enterprise institution client but also for the retail client. So we actually what we've been pushing is also promoting is like we do support like a Web3 wallet, right? So it's more like a decentralized wallet that can directly connect to the exchanges, right? If you don't feel comfortable have the money in the in the bank or centralized venue, you can consider just putting the wallet, and then you can just directly connect your wallet and trade with the exchanges, right? We want to offer this kind of flexibility to clients, right? So that they feel comfortable where they want their asset to sitting at.
Okay, on that note, so obviously retail investors tend to have like probably a little less capital and probably have like less like intense needs for their custody. So just in general, how have you seen like differences in how institutional clients and retail clients are approaching custody?
For us, retail predominantly custodizes with us. So these solutions that we have, like Copper and Fireblocks, are more for institutions. Cobo is actually more retail accessible. So we have, if you look at who uses custody, it's within the Cobo framework, it would be institutions plus retail. Within Copper and Fireblocks, it would be predominantly institutions. But overall, if you look at our assets, around 90% is kept with us. So the custody solutions are around 10%. So for us, the majority of our clients uses direct deposits with us, also because it's free, of course. So these custodians are not they have a business model as well, so they can't operate for free. While for us, it's part of our service offering. So it would raise cost if you want to secure, let's say, trust. There's of course a price involved.
Yeah, on our side, basically the institutional clients, they would just have more requirements around workflow, efficiency, recovery, and off-exchange settlement solutions.
Yeah, so I feel like, I mean, most clients, like retail clients, actually most of clients still having their assets directly with us. But as I mentioned earlier, institutions has been loud and clear that they want exchanges to offer custodians, like third-party custodian service for them in the near futures. You don't really hear that a lot. You know, like directly, so you have retail come to you say, I want to use a custodian service, right? But I think like from the retail business, we all think about is like how can help the retail have an easy access you know to the crypto assets. That's what we always think about, right? So we look at like we offer different kind of decentralized wallet or some tools so that they can more easy for them to convert their fiat into the crypto and then use the crypto to basically enjoy different kind of a product or different kind of service, right? It's not only for the crypto, but also NFT, and you can do the staking, right? So number of things. I think from the retail side, is still more about like how they can benefit from the crypto or from the DRT technologies.
Got it. Okay. And also, as we're at like 12:30 right now, just a reminder, you can send in questions for the Q&A at the end because we've got no questions so far. But I know that some people have some burning questions. I can just feel it. Okay. So now just like moving on to talking about maybe how things are going to change due to regulations. There's a lot of regulatory eyes on crypto now, like more than ever. And you can't always predict what's going to happen. And I'm sure a lot of these things maybe overlap with things you've already mentioned, but is there anything that you're doing to proactively be like what some might deem as more compliant in order to like prevent being in violation of any compliance that comes out as a result of FTX or anything from last year?
Yeah, so we are getting regulated in Dubai. We started this process well before FTX, so it's not FTX driven. At some point, you become more mature. Your clients are expecting more and more. So we took the decision. We compared a bunch of different regions. And in the end, as a derivatives exchange, not all regions cover derivatives regulations. So it's not, you can't just go anywhere you like. There's a subset of countries and jurisdictions that are suitable. And we chose Dubai, and I think it's a great choice because there's more of us going there, like Bybit. So it's going to be, or at least that's what I expect, a crypto hub going forward. And what it brings is VARA, the regulator in Dubai, has looked at, it's a new regulator, so it's a new regulatory framework, which is intended to be a best-in-class solution. So they looked at UK regulation, Asia regulation, European stuff, and they've created a bit of a blend, which is best in class in all these different pillars, which are part of the regulatory framework. So it's not only about trading, it's also about the health of the exchange. It's about the security of the exchange, the ops, the tech, the people, how do you vet new staff? All of that stuff is required to be written down in policy, and besides just writing it down, they make sure it needs to be audited. So you need to do what you say you are doing, which of course in the end will raise the overall standards of any platform. So I think it's a good thing. It requires more staff, it requires more scrutiny, so it will change our operating model, but you will get like ISO certification, SOC 2 standards, you get higher or different KYC standards, and in the end, that results in a higher quality platform. I truly believe in that. So yes, we're quite proud of what we're doing, and this is the start. So Dubai will be our hub, but we will get more licenses going forward. So most likely we'll get like a European MiCA broker license, and who knows, other parts in the world where we would onboard clients in a certain region under the regional framework, and then the flow is executed in Dubai. So our model is a bit like a hub and spoke model, where the core is Dubai, and then regulated broker entities across the world.
Yeah. Completely agree with Luuk. So for Bybit, we also moved our headquarters to Dubai. We actually already announced, like even before the FTX, that that's our intention. We have a IPA, and then now it's working on with the regulators proactively regarding getting the license that can fit our needs in Dubai. And we also try to get license from other jurisdictions. The interesting one, in additional to Dubai, would be Hong Kong, because this is Hong Kong is a financial center, and then they recently came out basically say that they would grant this the virtual assets license for the exchanges, and they've been telling the industry that they actually allow retail clients, right? Because license in Singapore is being very clear that they don't allow retail, right? Well, you have to be a credit investors, and also lay down the whole roadmap is like, you want to get a license, you need to basically start operation, file in before like June 1st, and then like to basically lay down like every single detail, like what you need to what kind of requirement you need to meet, right? And then the regulator has been really approachable to for to understand what are they thinking, right? They also have a deal quite amount of consultations with the industry's participant to understand like what's the concern, before they really put the rules and all the regulations in a like a go for the final stage. So that'll be another jurisdiction that we also spend a lot of time, resource, try to explore the possibility there.
For Cobo, we approach compliance with both licensing and technology. So on the licensing front, we are already licensed in 5 jurisdictions across Asia, Europe, Dubai, and the US. We're also involved in discussions with regulators in different regions as they seek to come up with crypto custodian licenses. And on the technology front, we position ourselves as a custody technology provider. So we design our solutions thinking of how the funds could be safe and in control in every possible extreme scenario that could happen to any company involved in the workflows. So by ensuring the full custody for our customers and the safety of funds.
Okay, and I guess you guys kind of already touched on this, but do you think that like regulatory enforcement going forward will change the geographical landscape of crypto? It's like supposed to be truly decentralized, that anyone in the world can use it, but certain regulatory bodies are making things difficult, maybe only for centralized entities. But do you see the geographical landscape changing at all moving forward?
So we're not active in the US. So I assume you're hinting at the US. The US is definitely has become more strict the last days or weeks. We don't do anything in the US. So we operate, typically our clients come from Europe, UK, Asia, Australia, that part of the world. So for us, I think if you look at those countries, of course, the regulators are going to step up. So it's evolution everywhere, and every part of the world has their own model, and every part is focusing on different aspects. So some regions are more focusing on crypto as a whole, a bit like Dubai. So Dubai simply says we're going to regulate everything, whether you're a custodian, a spot platform, a derivatives platform, and some parts, a bit like Singapore, for example, they do small stuff and they grow over time. And in 5 years from now or 10 years, perhaps all of them are at the same level, but not everyone has the same approach. But yes, I do think it's going to be stepping up. Of course, no country can stay behind, I guess. But some countries are more keen to make their country a hub than others. And that's what you see now. Dubai is welcoming companies and trying to create like a best-in-class solution, while other countries are more regulating out of protection and not really from a business mentality.
Yeah, I'll add to that as well. And since Cobo is headquartered in Singapore and we're also licensed in Singapore and Hong Kong, so I will talk about these two. So I think with the theme of diversification, Singapore and Hong Kong are also quite well known for robust financial governance. So I think this is an opportunity that these two regions can attract more funds and startups to operate in the region. And regulated businesses like banks and custodians from Asia Pacific can also be an interesting option for global companies to diversify and work with.
Yeah, I mean, there's not much to add. I mean, because JD and Luuk has already kind of covered, what I want to say. But I mean, we as a global exchanges, right? We do have our business in a different region. I mean, except US. But we of course, if the regulatory environment is more friendly to us, we definitely want to put more resources, right? Want to expand our business more aggressively. I guess that's as a global exchanges, that's always our strategies.
Okay, good answers. As always. So now I think we're going to go on to the last question before we get into the Q&A. So as FTX collapsed, it really spurred a movement for decentralized exchanges, especially just in November, because they were transparent by nature. Like there was no need to do proof of reserves, everything was on chain. What reasons do users have to now utilize centralized exchanges over decentralized exchanges, and how are you communicating that to clients?
For us, so as a centralized exchange, we are. So I think we're highly committed to remaining centralized. So we have zero efforts in establishing decentralized subsidiaries or whatever new efforts, because in our case, because of a few reasons. One is speed, so latency. You need a protocol that's fast enough to focus on options. So if the market moves, you need to process thousands of price changes at the same time, which frankly, I don't think any protocol really is able to do at the moment. And secondly, and perhaps the more important one, is portfolio margining. If you have a lot of positions outstanding from an options perspective, so you have calls, puts, longs, shorts, futures as a hedge, etc. We margin you based on the overall portfolio and not on the individual legs. And that's very difficult to achieve in a DeFi solution. And lastly, KYC and regulation and all that stuff, that's also virtually impossible to do properly from a DeFi standpoint. So, and we're dealing with, so Deribit is like 80–90% institutional. So we don't have millions of retail like some of our peers, but we have all the institutions you can imagine. And those people, they want a centralized solution, which is best in class in all these levels. So we have dedicated hardware. We have hardware, physical hardware that you connect to. You can put your cable on our solution. We have, or we're getting regulated. We have people that you can talk to, and that's what we think is important in long-term growth. So I'm not saying DeFi is doomed to fail. The opposite actually, but DeFi from an options perspective, I think is tricky.
Yeah. I mean, for us, we are actually 50-50, right? We are about 50% retail, 50% volume coming from the institutions. So it's the same time, like we do have a DeFi solution for the client as well, right? It's kind of connected to our Web3 wallet, right? So we just want to make sure like we can provide the service or product that client wants, right? But there's a difference between a DEX and a CEX, right? From the product angle, from the customer support angle, from the KYC angle, right? But I think in general, right, we always believe that, okay, there going to be either a regulatory market, and also there will be some people, they still continue to embrace the idea about fully decentralized. So we just want to make sure like we can have all this like a service and product, you know, for client to choose.
Cool. Okay, so thank you for answering all my questions. We will now move on to questions from the attendees. I'm just going to answer the one in the Q&A panel first because it's the only one in there, and then I can answer the ones in the chat. But you guys kind of already talked about it a little. Your companies are registered in foreign jurisdictions. New SEC guidance states clearly that qualified custodians must be registered in the US. What US solutions do you have?
Zero. We don't accept US persons at all, so we have zero, and we have zero ambitions. So nothing on our side.
Yeah,
in the US,
here, right?
Yeah, okay. We hope we're a little bit more than zero. So in the US, we're primarily positioned as a tech provider. So we'd be primarily pushing our MPC technology solution where it's co-managed custody. That's one thing. On the other hand, we could be recognized as a regulated overseas custodian. So that's another way we could work around it. And the other thing is that with Superloop, this potentially solves the problem of trading funds needing to trade on exchanges, but they're not able to hold funds on exchanges because exchanges may not be deemed qualified custodians. So Superloop may be a technology solution to solve these issues. Okay,
next question. How do you deal with the fact that crypto markets, exchanges, transactions are all 24/7, 365 days, like nonstop? And stablecoin custodians and fiat banking partners are like 8 to 5, or 8 hours a day, 5 days a week, and typically only open 20% of the trading time in a typical year.
Yeah, it's a great question.
Okay.
So for us, we manage in and outflow. So deposits and withdrawals are key, and the limitations of the banking system are relevant in that case, that we look at custody from a hot, warm, and cold perspective. So hot is connected to the platform, is available real time. Warm is easily available, and cold, cold is like going to a bank vault. So when FTX happened, out of precaution to make sure that we aren't hit by banking our limitations, we make sure that our warm wallet is topped up and higher than usual. So should there be bigger outflows because of the panic, and everyone on Twitter was shouting, remove all your assets as fast as possible, we took the precaution of having more readily available assets should we need them. In the end, it was not needed, so we moved them back. But that's it can be nasty indeed, operating 24/7 while some of your parties are not.
Yeah, quick one from us. As a custodian, we are sorry, Eugene.
Go ahead. Go ahead.
As a custodian, we are 24/7, 365, and we tend pretty quickly to customers. They have a ticketing system, and every customer also has a dedicated Telegram, WhatsApp, WeChat group, so they can just chat. They don't need to submit tickets if they don't want to. So that's how we handle it.
Yeah, I mean, I think the thing I want to ask, I look at this question from another angle, is that's how the reason why we think we're able to compete with the traditional financial exchanges. Once the regulation or the regulatory environment is more clear, right? Because like with our infrastructure, we're able to operate 24/7, right? But for a lot of traditional financial market, because the existing system or existing practice, they probably just offer, as what I mentioned, is I open 20% of time, right? So that's the one thing, is we talk about organizations of a lot of traditional financial products like bonds, right? Like real estate, right? In the future, right? That's the reason why the blockchain technology can bring you a lot of efficiency and then lower the cost, right? So I would look at this as like the reason why it's not something that we want to deal with, but it's more like, in the future, how we can expand our business to compete with the traditional financial when the regulation is more ready.
Nice. Okay. So this person is curious to get your opinions after reviewing the SEC proposal. How do you see registered investment advisors accessing DeFi and qualified custody? If qualified custody is added into the equation, also given their proposal, it appears they are also targeting effectively managing pre-funding on exchanges or over the counter, as they also considered pre-funding problematic given credit and counterparty risk. Kind of a mouthful. Also US related, so if you're not interested in the US, feel free to not answer.
For us, I think the answer is pretty similar to what we answered previously. We position primarily as a tech provider in the US. Okay, that's one angle. The other angle is that we could also be overseas regulated, and also with the off-exchange settlement, you don't need to pre-fund. So, and again, it's a technology angle, so that's what we're going with. But of course, we do also have a entity in the US. We do have the basic license, and over time, when the climate is right, we will seek to do more.
I think regardless of the licensing part, Cobo and others are solving the pre-funding solutions or the pre-funding requirements. So that's, I think, what is being mitigated by the services they offer. If you don't trust the exchange as a money manager or asset manager of some kind, you use a custodial solution which limits the exposure you actually get. So regardless of this specific rule or requirement, I think that's what you will most likely see over the coming years, that fund managers or asset managers will have the requirement for their operations to use one of the selected custodians instead of trading pre-funded on exchanges, which is perfectly fine for us. It's their choice.
Cool. Next question. If I was a big fund trading on multiple exchanges in order to secure best execution and was with one of the custodian solutions, can you explain how potentially pre-funding those exchanges would work, or would I be limited to the exchange of choice by the custodian? And they're talking about spot crypto as opposed to derivatives, but if that matters.
So from what we know of the other solutions, the other off-exchange solutions out there, I think different custodians have slightly different implementations of the off-exchange settlement in terms of how they lock collateral or how they do settlement. For us, the entire process is MPC driven. There is no omnibus in between. The tokens are always in your wallet, in your control until the moment you have to send it over. That's it. So, and the other thing is, to be honest, I don't think you'll be limited by choice by the custodian, because I think, firstly, like I mentioned, this is an industry movement. There are a few forward-looking exchanges that are already embarking on this, starting to do this. And I do see in the longer run that none of these exchanges will be exclusive with any custodian. So it's just that maybe custodian A will have these exchanges first, custodian B will have the other exchanges first. 6 months later, everyone will have the same exchanges. So it's more of a consideration of how much do you believe, how much do you think that technology, how they're solving the problem in the technical way, it's suitable for your company structure, your workflow, and also how much of the cost structure, where they are licensed, all this, how much it fits your organization. I think these are other considerations, because I think in terms of exchanges, it would not be too exclusive. And also, I think it's also good to diversify across different custodians.
Nice. Okay. How do we get to global regulations? Who has the clout to get all of the developed countries to sign on to a regulatory framework? The Bank of International Settlements, IMF, World Bank. It can't be that every country rolls out their own regulations. There has to be a core set of regulations that all countries sign on to.
An amazing question, but a very difficult answer, I think. In a perfect world, yes, there would be global legislation, and it would be simple for all of us to abide because the standards are obvious and clear. In reality, I don't think any of those names would have the global clout to actually get it done. I think perhaps one exception, the FATF, the Financial Action Task Force, from a KYC AML perspective, they do have quite good reach. So I think their requirements are implemented globally. So perhaps over time, the reach might change. But if you look at, like, let's say, full set of regulations for one body to implement all of it, I think we're far from there. But the AML KYC stuff, those standards, I think also have higher priority globally. They can be imposed by certain bodies, but I think the Financial Action Task Force would be a good start.
Yeah, I mean, if we look at this, you know, from the experience of the traditional exchanges, right? You know, like US CFTC, Singapore MAS, or Hong Kong SFC. So obviously let's say the CFTC will have their own rules or regulations, right? But at the same time, they also will do this remote recognitions license. So which means that if let's say I think CFTC also called non-action letters. So it's like, okay, you also have your license, let's say from Hong Kong, but they were kind of like remote recognize the Hong Kong's framework, so that as an exchange, you once you receive the recognitions, you're still able to solicit with the client from US. I mean, something like that. Basically, it's like kind of remote recognition, but of course not right now, but maybe in the future. I mean, we just talk about like from the exchange license perspective. So that's we've been actually seeing, you know, in the traditional financial industry.
I'd just like to jump in to address the previous question. I may have misunderstood the previous question on getting the best execution. So you can unlock collateral from one exchange and then block the collateral for another exchange to get the mirror and credit line on the other exchange. Locking collateral is not an on-chain transaction, so it's very efficient.
Okay, and we are just about at time. Thank you to our panelists for having this amazing conversation. If you guys want to drop or like just like say how you can get in contact with you, I know a couple people might be asking for contact information in the chat. So if you just want to like share like email, Twitter, whatever works best for you, just you can go around and say that.
Yeah, you can find me on LinkedIn, but otherwise you can also just mail me at Luuk with 2 U's, Luuk @deribit.com.
Same, LinkedIn or sales@cobo.com, or my email, junde.yu@cobo.com.
Yeah, I'm on LinkedIn and can be reached out also on the Telegram. My Telegram handle is at ECGold, ECGold.
Okay, so again, thank you everyone for coming. Thank you panelists for having this great conversation. And if you want to like relive this really fun time we had, this will be posted to YouTube. But if there's nothing else to add, have a great rest of your day.
All right, thank you. Thank you, everyone.
Thank you. Bye-bye.